In this week's video, we'll look at observable, unbiased, and binary evidence to help us answer the question, are the setups in place for a stock market correction? In last week's video, we looked at the year 2000 and 2007, so we basically reviewed pre-bear market periods. In this week's video, we'll look at pre-correction periods in 2011 and 2012 and compare them to the present day. If you're relatively new to the fold and you're a longer-term investor, you should be able to answer these questions. How will I handle a stock market rally that lasts for 2 or 3 more years? Or how will I handle the next inevitable 20 to 50% decline in stocks? For us, the answer is the CCM market model. The 4 charts we'll focus on in terms of examining corrections and what they look like and what the observable evidence looks like. We'll look at the credit markets, stocks versus bonds, long versus short, and the weekly chart of the S&P 500. We'll also provide an update for our fractals analysis relative to the S&P 500 daily and the 13-year breakout on the weekly chart of the S&P 500 index. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Before we get into the charts, if you haven't seen this post here on our blog, Short Takes, I suggest you Google it and take the time to read it. It helps us understand why monitoring the market's pricing mechanism, as we do with these charts and with the CCM market model, why it's important. This is a weekly risk-on, risk-off chart used in the CCM market model. It's one of the CCM Big 4 charts that summarize the big picture in terms of the market's tolerance for risk. We're looking at weekly JNK junk bonds or higher yielding bonds relative to more conservative treasuries. It's a risk-on, risk-off chart. This is what risk-on looks like when the ratio is rising. This is what risk-off looks like. In the bond market, we can also think of it as the ratio of I'm confident they will pay versus I'm nervous about bond defaults. This is I'm confident they will pay. This is I'm nervous about bond defaults. Purpose of the exercise. You can see here in 2011 the ratio is falling. That tells us we have a I'm nervous about defaults profile. The ratio is clearly falling here. We have bearish looks here. Blue below red, slopes both down, price below. That's a bearish look. A bullish look is price above the blue and the red moving averages, blue above red, and the slopes of both up. You can see here the ratio starts to fall 5 months before this plunge in the S&P 500. In 2012, the ratio is falling, clearly waving warning flags in the credit markets 5 weeks before this sharp drop in the S&P 500. So these slopes tell us a lot about risk tolerance. These slopes both say, I'm nervous about bond defaults, and I'd rather collect a smaller yield with conservative treasury bonds than trying to collect a greater yield with higher yielding junk bonds. This is a warning flag. This is a warning flag. Here are the slopes in 2012 and 2011. This line is this line, and this line is this line. Compare that to the present day. The present day, as of the close on December 6, 2013, clearly aligns with I'm confident they will pay. How the market model uses this. We have price above blue and red, blue above red, and the slopes up. That's checking positive or bullish boxes in the CCM market model. It doesn't tell us how long this will trend in this direction. It doesn't necessarily predict anything. We're looking at market profiles. This is a bullish profile, and we read it as such until the observable evidence begins to shift. You can see the observable evidence begins to shift early, in this case before the stock market falls, and 5 weeks in this case. The same concepts apply to this risk-on versus risk-off ratio. This is stocks, the S&P 500, relative to bonds, or the aggregate bond fund ETF with the ticker symbol AGG. This is what risk-on looks like. It tells us that investors have a greater demand or desire or conviction to own stocks relative to bonds. When the ratio is falling, this is risk off, and it's telling us that the conviction to own conservative bonds is greater than the conviction to own growth-oriented stocks. Risk on, risk off. You can see here the slope is foreshadowing problems, telling us that the demand for conservative bonds is increasing here relative to stocks. Slope is down. Eventually the stock market corrects here. This is the S&P 500 shown on the bottom for reference purposes only. Later in 2012, we make a lower high. We get a bearish cross here, blue below red, slopes down, price below both. Look how early the lower high comes and the bearish look in this correction. It's telling us that defensive assets are now in greater demand than growth-oriented assets, and it's time to get defensive. Here we get a bullish cross telling us that stocks are in favor, price above both blue and red, slopes of blue and red up and blue above red. This is full bore bull. Notice as the S&P 500 gains inside of this green box, the whole time we have a bullish moving average crossover that stays in place. These moving averages help us discern between volatility to ignore, volatility to ignore, volatility to ignore, and volatility to respect, volatility to respect, and eventually the stock market declines. In the present day, you can see we recently showed you cup and handle patterns on many charts. That's a bullish pattern, and indeed it produced bullish results. This ratio right now is in full bore bullish mode. Price above blue and red, blue above red, and the slopes are up. As long as it looks like this, it will check bullish and binary boxes in the CCM market model. If it morphs into something like this or this, the model will begin to step away and reduce risk. The same concepts apply to this chart, which is risk on versus risk off. Also part of the CCM Big Four charts. We're looking at, would I rather be long the S&P 500 relative to would I rather be short? Why do we look at this instead of just looking at the S&P 500 in isolation? There's no question there's some duplication here. Part of it's psychological. We like to think from an opportunity cost perspective. If the answer to the question, would I rather be long or short, is long, as it is in this case when the ratio is rising, it tells us something about all of our long positions. Conversely, when shorts start to dominate relative to longs, so we're at this period here, price below both, blue below red, slopes of both down. This also tells us something about all of our long positions, and it tells us maybe we should question all of our long positions. Here it's telling us give your long positions the benefit of the doubt. Make the market force you out of your positions. You can see here we go to the bearish look as we just described. Below is the S&P 500 for reference purposes only. We get the bearish cross, stocks drop. We get the bearish cross here in 2012. correction continues for several weeks after this. Here, this is our bullish look, price above, blue above red, slopes of both up. Notice we get the cross here. We never get a bearish cross in this period. Volatility to ignore, volatility to ignore, volatility to ignore. Ignore it. During this whole time, we maintain a bullish look from a moving average perspective, and the stock market inside of that box does well. What the models don't tell us is the duration or the severity of these corrections, especially early in the process. You can see these are shorter in duration here, but you'll also notice that quickly the ratio gets you back on track. Quickly the ratio gets you back on track. Presently, the look of this ratio is bullish. Price remains above both moving averages, blue above red, and the slopes are up. If and when, and eventually it will, morph into something like this, then we will begin to reduce risk. We give long positions the benefit of the doubt as long as it looks like this. This is the last chart in the CCM Big Four. It's the one that carries the highest weight in the CCM correlation model, which is one of the sub-models that feeds into the master CCM market model. Why does it carry the highest weight? Price is more important than anything, so it by far and away carries the highest weight in the model. You can see we clearly still have a bullish look here. You can also see that when we had a sharp decline in 2011, relatively sharp decline in 2012, and a second sharp decline in 2012. From a trend perspective, prior to the sharp decline, we have a clearly visible and discernible lower high that's in place, waving yellow flags on the weekly chart of the S&P 500. This is telling you, be careful. You can see it before this happens. This is telling you, be careful. You can see this lower high before this happens. This is also a lower low here. This is a lower low. All of this speaks to a trend change, a trend change. Here, in late 2012, a discernible lower high in the weekly chart of the S&P 500. In the present day, we do not have a discernible lower high. In these cases, we did not get a discernible lower high. However, that also tells us something. These corrections were not nearly as sharp or pronounced, nor did they last as long as these corrections that were preceded by a lower high. Wanted to provide an update to our fractals chart that we covered back on October 19th. If you haven't seen the October 19th video, it talks about the concept of markets do not base forever. When markets move sideways, eventually they're going to break out in a bullish manner or they're going to break out in a bearish manner. We noted 8 weeks ago when this broke out here that this was potentially a bullish breakout that was similar to this point here, point A, or this point here, point B, or this point here, point C. After point A, the market advanced for 21 additional weeks. After point B here, the market advanced for an additional 12 weeks. After point C, the market advanced for an additional 19 weeks. Here, we hypothesized that this was bullish. So far, so good. We've advanced now for 8 weeks. We took a little bit of a break this week, which is a good thing because it erases all of the consecutive up weeks analysis. You can see it's not unusual to get some down weeks in these moves. A down week, several down weeks, but eventually we moved higher. The concept of markets do not base forever applies to longer term and shorter term charts based on the concept of fractals. The October 19 video covers this chart in detail. And here we can port the concept of fractals to a weekly chart dating all the way back to 1997. You can see from point A to point A2, the stock market went absolutely nowhere. That's a consolidation pattern. We also went nowhere from A2 to point B. Therefore, we went nowhere since this high in the year 2000. We move all the way out to early 2013. This is a consolidation pattern. Markets do not base forever. And here we have a clear bullish breakout that's been retested here and confirmed with a series of higher highs and higher lows. Based on the concept of fractals, this tells us that the stock market could move much, much higher from a probabilistic perspective, looking out weeks and months. We don't manage based upon this chart, and we don't manage based upon the previous statement. We manage based upon observable evidence. We also know that a breakout that fails can lead to sharp declines. Point of the exercise, as long as we remain above the blue box, and as long as we're making a series of higher highs and higher lows, the odds favor additional upside in the stock market. When will it change? Have no idea. Don't need to know. You just need to pay attention. In fact, having an opinion about when it will change can actually be negative because it brings bias into the equation. You're much better off going into next week with the idea, A, I don't need to know what will happen next. B, I have no idea what will happen next. And C, I'm confident that I will pay attention. And D, I'm confident that I will make the necessary adjustments. The market model started scaling back in with our cash on October 10th. The stock market bottomed intraday on October 9th. The model was basically fully invested by October 18th. Since the October 9 low, the S&P 500 has gained 159 points. We'll stay with our long positions as long as the market allows. The market has to force us out of those positions. We've only made 5 trades in the last 6 weeks. Why? You have to hold your positions during the meat of the trend to make money. It's extremely important that we maintain maximum flexibility. Our job is to stay aligned with the market's pricing mechanism. When the market changes, we have to be willing to change with it. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.